Welcome everyone. And we'll give people a few more minutes to join us. But if you, for those that are new to this is the exciting world of multifamily meetup presented to you by Excite Capital. And I'll do a formal introduction of the meetup later when I do the introduction of the speaker. But for now, just settle in, grab a drink, grab whatever beverage or food you need to settle in tonight, and we'll get into it soon. Get this started. Welcome to the exciting world of multifamily meetup, presented to you by Excite Capital. I am Dr. Julius, CEO at Excite Capital, and co-hosting with me is the entire Excite Capital team. Including my two co-founders, Mr. Leslie Awesome and Mr. Tenny. But also we have Miles Ill, we have Kayla Daughtry, we have Macy Price Belter, we have Manny Awesome, all part of the incredible Excite Capital team. So today you're in for a treat. You've got Dr. George Ozoude, a seasoned and board-certified orthopedic surgeon with a focus on sports medicine, and founder and CEO of Time Health Capital. He's got an extensive background in both the world of medicine and the world of investments, and he seamlessly bridges the gap between health and wealth, embodying a nice synergy in these two worlds. So he is an incredible investor, and has actually invested as a limited partner in over 20 real estate transactions. And these ventures collectively encompass about 4,000 doors. Is allocated capital north of $1.3 million in these deals. And they're mostly like large multifamily properties, medical offices, and is also invested in the oil and gas and agricultural sectors. Dr. Ozoude is committed to promoting financial independence through real estate investing. Beyond his personal success, he's also served as a mentor and co-general partner in various real estate investments, providing guidance to others seeking financial stability and security. In 2021, November 2021, he's been an esteemed member of the Real Estate Guys Syndication Mentoring Club, where like-minded professionals and enthusiasts converge to share, learn, and collaborate on real estate syndications and investing strategies. So I know that you guys are in for a great treat today, because Dr. George Ozoude is about to share some great insight to us. On a personal note, George is an incredible human to me. When I started in the world of multifamily real estate investing, one of the things that I've discussed on this particular platform many times before was one of those identity crises that I had to go through. The fact that my core identity was as an orthopedic surgeon, and all of a sudden I was in the world of multifamily, or trying to break into the world of multifamily real estate. And I was really concerned about what other orthopedic surgeons, what other healthcare professionals were going to say about me. Are they going to still take me seriously as a joint replacement surgeon? Are they going to not take my academic pursuits seriously? Are they going to think maybe I'm having problems, making money as an orthopedic surgeon? I mean, there was a lot of self-talk that were negative that I had to kind of go through. And one of the few people that really, truly understood and actually encouraged me in those early days was Dr. George Ozoude. He already knew so much about multifamily by that time that I was just astounded. I was like, okay, so I'm not alone. And George may not understand how powerful that is when you actually have somebody who truly understands where you're coming from and actually is super encouraging of it. But I would never forget that, George, and I'm super excited that more and more we're collaborating, more and more we have continued to grow. I've seen the growth you've experienced since then, and I hope you can say the same of me. But without further ado, I'm going to let Dr. George Ozoude take it away. I'm super excited about tonight, and thank you so much, George, for who you are, and can't wait for you to share a lot of value with this incredible people. Go for it. Thank you.
Oh, thank you so much, Julius. I appreciate that intro. Too kind, man. I'm humbled and I'm honored to be on your platform and with your community this evening, sharing, just my journey and kind of my, experience in investing. And hopefully this will just provide value for everyone here tonight, will encourage and foster discussion and learning. I always say, I'm here to share and learn from. I actually learn a lot from everyone else when I do these talks, not only in preparing, but also just the feedback and the discussion is invaluable to me. So again, I'm honored to be here tonight. I'm going to share my screen and then jump into the content tonight. Please just anyone give me a thumbs up to make sure they see my screen. Okay, perfect. Okay, so tonight's talk, the topic is about building generational wealth through real asset investing. Of course, the obligatory disclaimer, this information presented is not personalized investing advice. Please consult with any appropriate professionals in consideration of your own personal circumstances. As Julius mentioned, I'm an orthopedic surgeon. I've been here in Houston, Texas since 2013 practicing. I recently opened up my own private practice, but I've been in the field for 15 years. I'm also a real asset syndicator. I've started that journey 7 years ago. It's been a wonderful journey. I'm still learning a lot, and I'm happy to share that experience thus far. As Julius mentioned, I've invested 1.5 million of capital deployed as an LP for over 25 deals. And then as of the last year, I've been a part of several other operative teams as a co-GP and have accumulated $50 million worth of multifamily assets under management. So the goals for tonight are to discuss the fundamentals concepts of what wealth is. And then I'd love to go into just discussing what real assets are. I think it's a term that, I've learned from my real estate syndication mentoring club, and initially when I started, I always thought about real estate, but I've come to learn about real assets and what that encompasses. So I'd love to share kind of my views on what that is. We'll definitely describe ways to generate lasting wealth through investing in these real assets. And we'll even suggest on ways anyone can get started even today. So let's first dive into the concept of wealth. And I think we're all familiar with the financial aspect of wealth, monetary wealth. But there are actually 8 other forms of wealth or capital. And I'd like to touch upon a few just to kind of set the table. There's material wealth, okay? And this is the type of wealth where we physically have things that are valuable to us. So this can be things like our vehicles, which provide, an efficient way of traveling. This can be tools and technology that just make our modern life just a more valuable and enjoyable thing. Then there's the knowledge and intellectual capital, that know-how. So we can actually have wealth of knowledge, and that's a term, right? And you can leverage that. This is like the book smarts that we get, the learned skills that we use in our day-to-day. And then just like there's the importance of book smarts, there's actually the importance of experience. So experiential wealth. This is, I always like to make the analogy of me as a doctor. I went to school for 5 years and then 4 years and then residency for 5 to 6 years of training. And I got a lot of book smarts to start. And then I needed the actual experience. I needed to learn from, mentors in order to know how to get in and out of situations where I'm treating patients in surgery. This is a different kind of knowledge, and it's very valuable, this experiential knowledge. Then there's the social knowledge. This is the importance, the human need for strong connected relationships and networks. This is super invaluable. I think in all aspects of anyone's professional career, maybe even more valuable than financial capital. It's actually the social capital that you carry. Then there's the spiritual capital. This is one that I've come to appreciate more over the last 5 years or so. This is the mindset, right? The emotional foundation of grit and strength that you have. These two capitals, I think, combine into your cultural capital. This is how you interact with the world around you. Okay, how you understand different aspects and different types of cultures in the world, and how that can help with your day-to-day experience and your experience of wealth. And then there's the last two, which I think are the most important forms of wealth and the important forms of capital. This is your time capital and your life capital. This is your what I call your health. And I think these are the two most important because they're the most individual. They are the foundations that I believe you always need to attend to and cultivate in order to set yourself up to pursue the other capital sources and forms of capital. And that's why I name my company Time Health Capital. It means a lot. And I think it's something that we can all resonate with. We don't get any more time. And what is life without our health, right? And so time and health are two super important forms of capital. But let's dive a little deeper into financial capital and wealth, because this is where the source of generational wealth actually comes from. And financial wealth progresses through these stages. And we all start at this initial stage of dependence, right? We're all born and we're dependent, right? We're infants and we need help. So we're all dependent on, our family support. As we get older, hopefully we progress through the other stages of wealth. But even as adults, sometimes we're dependent. Folks can be dependent on governmental assistance or programs. And in this stage, we don't have the ability to generate enough income to cover our expenses, our basic needs, or any incurred debt. The next stage is solvency. And this is a stage where we graduate to, earning income, but it's just enough to at least stay current on your debts and provide the most basics of needs on that Maslow's hierarchy. Then we get to financial stability, where we're actually making more income, enough income to comfortably not only cover our basic needs, but also take care of those debts and even start to save. And that's when we get into this financial security, where we have enough extra income, earned income, to start saving, creating emergency funds, comfortably covering our debts, and even start planning for the security of our financial future by making wise investments. And if we do that right, we'll get into the next important 3 stages, which really lead to that generational wealth, and that's the financial independence. This is where we've made smart investments and we've developed enough passive income to actually cover our most basic of expenses and any of our debts. We're out of debt at this point, at least bad debt. And this is the point where we're really starting to accelerate and reach our potentials. From this point, you go on to financial freedom, where you are making so much more than your basic needs that you're actually able to live the lifestyle that you desire. And that can be different for everybody, right? But you're able to go beyond just your basic needs and comfort. You're able to do more and provide more, not only for yourself, but your family, and maybe even for others, charitable giving and things like that. And then the pinnacle is this financial abundance stage, where we have so much extra earned and passive income that we're able to really have large impact on not only ourselves, our families, generations to come, and for charitable causes, if desired. So that leads us to what is generational wealth. This is the assets and financial resources that we're able to pass down to the next generation. That could be friends, that could be family, that could be charitable causes. Why is this important? It's because we desire this financial freedom, but we really desire the other forms of capital. We want our time, right? We want our health. We want to have a strong sense of community. We want that social capital and that relationships. And we want to be able to set those that who we love and care about. We want to be able to set them up to also experience those forms of wealth and capital. So how do we create this financial wealth to get us to generational wealth and to these goals that were stated? Well, there's 4 ways that you can that have been described to generate financial wealth, as shown us by Robert Kiyosaki in his cash flow quadrants. You can be an employee, you can be a self-employed business owner, or you can be a big business owner or an investor. And now these all have their pros and cons. On the employee and self-employed side, on the left side, you're going to have more trading time for money, and we all, usually start in this side of the wealth earning capacity. We're all trading time for money. The downsides of this is that, yes, you're trading time, you're likely going to get taxed at a higher level, and then you have this ceiling that doesn't allow you necessarily to graduate and elevate and advance into the 5th, 6th, and 7th stages of wealth progression. Same thing with self-employed. Even though you're earning a slightly or a higher income compared to an employee potentially, it actually comes with a big trade-off. You're actually going to trade more time, and you're going to potentially get taxed higher. And that, again, will limit your ability to graduate into that 5th, 6th, 7th level. So what we really want is to get to the right side of this continuum, which is the big business owner and investor side. Here, we're creating systems and processes that allow us to leverage other people's time, other people's money, in order to build passive income streams and therefore get to that financial independence mark and beyond. Now, the good thing is you can exist in any form of any sides of this continuum. And in fact, you could play in one or more of them at the same time. And being an employee and a self-employed business owner, you can still create, strategies in order to also be an investor and start to accumulate that passive income. So over time, with wise investments, you can graduate to that point of financial independence. So as investors, what can we invest in, right? And I like to separate into 2 categories. There's what we're really familiar with kind of by conditioning is the paper assets. We're all aware of the stock exchange and, bonds, and you can even, there's probably less known, but there's, things that you can invest in like currencies, foreign exchange. You can invest in debt notes or promissory notes. These are all forms of paper wealth, right? They're tied to not a tangible thing, which is what we see on the opposite side, which is a real asset. And that's the basis of this talk is, what are real assets? Real assets include real estate, has its name, it's real. They're commodities, things that we use, things that are in our day-to-day life, oil, gas, textiles. They're the things that we need, like food. They're tangible, precious metals. They're things that, are tangible. Again, we can store them. And then there's actual private businesses, which is really just an accumulation of all the aforementioned things. They exist on real estate. They require equipment and tools and technology. And these are all real tangible assets for that business to be productive. And so we can invest in that as investors. We can choose these real assets, but why? Why choose real assets over paper assets, right? Well, many reasons. And I like to point out some of these. When in choosing real assets, you're choosing the benefit and leveraging things like the track record, right? Real things and real tangible assets have been around a lot longer than the New York Stock Exchange, right? The majority of them, for that reason, are just not as volatile, right? They exist in a finite supply, which makes them more valuable. And for that reason, they're very resilient compared to paper assets. They're not perfect by any chance, but it's very hard to manipulate, real assets, because it's something that's, can't be vaguely manipulated in a market like a stock market exchange or, you know, taxed. It's hard for it to get taxed in the same way, or confiscated even in the same way as, say, digits on a bank account, right? So it's very resilient compared to paper assets. And for that reason, it's known as a great inflation hedge. It's hard to devalue. It will rise, typically rise for the most part with inflation. And not only can it accumulate wealth, but it can serve to preserve wealth, as opposed to paper assets, which can really take hits with inflation and devalue in the long run against a falling currency. So how do you actually create returns from these real assets? Well, there's several different ways that we understand this. In the financial sense, there's three. You can create cash flows, which means that once you purchase these assets and invest, they pay you to own them, meaning they kick out a distribution or they kick out a dividend. The other way is through appreciation, meaning that the price or the value of what this asset is worth tomorrow may be more than what it is today. Finally, there's tax savings. So all the real assets that we've talked about are things that people need no matter what, whether there's good times, bad times, you know, whether you're in a third world country, first world country, you need these things. So the government actually incentivizes investors, everyday investors like you and me, to invest in these real assets. And they do that by giving tax savings, tax breaks for that. Now, those are the financial returns on investment. But I also think that there's non-financial returns on investments that are very worthwhile noting. And that's things like social capital. And what does that mean? A lot of times when we're investors, we can invest into these assets as groups, like in syndications. You know, Excite Capital is a multifamily syndication group. They bring together communities of investors, of like-minded people. And this is, again, invaluable when you create social networks that you know, like, and trust, that are like-minded. Same thing with materials. We're investing into things that we use on a daily basis. And so, and these are also things that rise with inflation. So it makes sense to invest in oil and gas. It makes sense to invest in food or residential housing. These are things that we're always going to need. And so there's this extra additional return on investment that I think is very worthwhile noting. So there are many things we can invest in. And that list I gave was just a surface. There, you can go deeper. They have sub-asset classes within each of these, you know, investment assets. With real estate, you have residential or commercial. You know, you have, you know, sub-asset classes underneath that. You can have single family, multifamily, senior living, student housing, short-term rentals. On the commercial side, these commercial buildings where it's not residential, you can have retail, office, medical facilities. You can have industrial warehouses. Like we mentioned, oil and gas, these are real estate plays on oil fields in, you know, so this is, again, still a real estate play. Agricultural farmland, mineral rights, which we'll talk about, a lesser known, you know, offshoot of oil and gas, is a possibility. Subsurface rights is what they call them versus surface real estate rights. So before that's the list of what you can invest into on the real asset side. But before going into that, I think it's very important for investors to actually determine why they're investing, their big reasons. What are their goals? And it goes beyond just your investor goals. It goes into your personal goals. You have to really take time and reflect and figure out what it is that you want, that you desire, and why. And I think that will help to define how you're going to get to that endpoint. How do you get from A to B? Is it going to be where you prioritize cash flow, meaning your passive income is the most important thing, and your financial independence is what is going to get you to your end goal? Or is it capital appreciation? Do you want to grow your net worth? And that's going to get you to your goal, your personal goals. And once you appreciate or accumulate that net worth, do you want to preserve your capital? Are you in the season or the phase of your life where you've worked a long career and you've accumulated a good net worth and you want to preserve it instead of actually trying to appreciate it more? So tax savings is another thing. Some of us may be in professions that are very high tax bracket, and that's our priority. Taxes is by far the highest expense in anyone's lifetime is your taxes. It's the most expensive thing you'll pay for. So that might be a priority. And within all these four settings, it can look a couple of different ways. It can be an aggressive cash flow versus a conservative cash flow. It can be aggressive tax savings versus conservative, aggressive appreciation or capital gains versus conservative. So you need to define that. You need to define your risk tolerance in relation to your personal goals. There can be short-term, versus long-term with each of these investor goals. So it's important to define that before you match it to the different types of real assets, because as we'll go through in a bit, these real assets have pros and cons. They have, advantages and disadvantages. And so you want to know those before you dive into them to make sure they're aligning your investor goals with your personal goals. But that's financial again. But I also always like to highlight the additional goals that come from investing. And that's things like legacy. Okay. And that's the generational wealth component. And so this could also impact which asset class you choose. Some investments actually are long enough term, call them super long term, that they serve as a legacy investment, something that you'll own for so long that you'll be able to pass it down. You can, like we mentioned before, in syndications, you can start to associate with like-minded people by getting the community effects, goals of investing. With international investing, we're not just relegated to the US. You can invest in international real assets. And this actually can be tied to potentially getting residency in those international markets. And this may be a personal preference, a part of your life goals to settle outside of the US. Everyone's different. And so this can actually play into that. Then there's philosophical goals that can be achieved. There's different reasons why you may choose a certain asset class that ties to some theory or some important aspect of what you care about. Things like clean energy or affordable housing. So a lot of other goals that can get attached that are not just financial. And it's important to keep that in mind. So let's talk about some of these assets, where they have advantages, where they're stronger. Let's start with single family. This can be broken down into, long-term single family rentals or short-term rentals. They both have different, advantages. With long-term rentals, you're not going to get as much cash flow, but you can get a lot of appreciation and still get some tax shelter, right? The majority of them are not like short-term rentals where it's a little bit more of an aggressive cash flow, if done right. And then on top of that, for short-term rentals, there's even the advantages with taxes that go beyond just what you can get with a long-term. There is W-2 earned income loopholes that you can actually shelter some of your earned income from the actual investment, the depreciation that you get from these short-term rentals. Then there's things like wholesaling, fix flip. These are more transactional types of investments. So it's shorter term. These are not long-term holds. So if your threshold, your risk tolerance is something where you want to get in and out quicker, you can invest in these, but this is also trading time for money. This is more active, where long-term and the short-term can be a little less active. So again, it depends on your goals and what you want. Then there's development, where there is no cash flow until the actual property is built. So the trade-off for this, because it's a little bit more risky than investing into an asset that's already, existing, that you acquire, you get a higher appreciation. So there's that risk reward. Higher risk with development, lower cash flow, but usually it has a more aggressive appreciation compared to something that you acquire. That's on the single family side. On the multifamily side, we have similar, designations. You have the small multifamily, where it's 5 to 75 units. And this can be owned actively because it's small enough that maybe one person or a small group of joint venture partnership can purchase the property. It can be private, if it's your own, and therefore you have this legacy component. You don't have to worry about other investors if you want to hold on to it forever until you're ready to pass it on. Then you have large multifamily. XI Capital deals in this range, right? This large multifamily where you get economies of scale, and you usually have to syndicate these deals and bring other people into the deals to acquire them. 75 plus units. It is cash flow oriented, it's conservative, because again, on the acquisition side, you're acquiring units that are already existing, stabilized properties, hopefully. But it does provide this conservative cash flow. And I call that like around 6 to 10%, which can vary depending on the cycle, depending on many factors. But this is passive versus, the small, which could be active if you buy it by yourself, right? Again, on the development side, similar as multifamily, time it takes to develop, you're not going to get any cash flow, but the equity multiple, meaning how much it appreciates, can be very high. So this can align with you if, say, you're not worried about cash flow, you have a good paying earned income, you're not really worried about financial freedom, meaning you don't really want your passive income, that's not as high of a priority. You don't really want your passive income to replace your active income, but you're just okay, we're working your 9 to 5, and you just want to put this capital to work and develop aggressive capital gains and appreciation. This might be, the avenue for you. Then there's other assets, storage, and this can be a bit more aggressive cash flow where you're getting above the 6 to 10%. You're getting something more akin to 50, double digit, 15, 20, 25%, depending on many things. But this is, the ceiling, you have a higher ceiling of this more aggressive cash flow. And you may be interested in it if it's more recession resistant, so it can go through downturns easier than some other assets that are more impacted by the economic cycle. There's agriculture, again, things that you need all the time, like food. So these are recession resistant, and these can be, different types of assets that you can cash flow on as well as pass on, because a lot of them are long-term, 25-year, 30-year type of investments, because it can take a while for the actual commodities, which are the crops, to grow and yield dividends or returns. Then there's retail and office, because these are more stabilized with longer term tenants. Usually they're having 10-year leases. So you get a lower risk profile, and therefore it can be a little bit more of a conservative cash flow compared to other more riskier assets. Of course, right now we're in a part of the economic cycle with specific factors that are affecting office in particular. So that may not be the case right now, but historically, you can typically expect some predictable conservative cash flow. Then there's medical office. You can invest in medical facilities. This was actually my first foray into the investing space, where cash flow is actually the priority there. And there's not quite as much appreciation. It's still there, but it's not quite as much. You still get tax benefits. There's operational and burden and liability. So this is something that you may invest in passively versus you having the know-how, which is possible. You can actively invest in this, but it's a lot more operationally intensive, time intensive, and skill intensive. Same thing with senior living. It's aggressive cash flow. This is a growing demand based on just the current situation of our society. We have a baby boomer age group that's retiring, and this type of asset, this product, is in demand. And I call it this type of investing momentum investing, where you see where the puck is going, where there's a social trend, and you can actually benefit from that vision, that foresight of that social trend. Then there's commodities. You can invest into oil and gas by either investing on the surface rights. You can invest into things called working interest, where you're investing into the tangible drilling, the intangible drilling costs, the actual equipment that's used to search, explore, find these oil investments, and it's something that's always going to be in demand. You can see aggressive cash flow with these markets just because of the demand for oil. It's in everything we use and how we travel, and it's always going to be in demand. So these have special W-2 tax shelters. So it's worth noting that you can specifically prioritize tax sheltering through this type of investment. Then there's subsurface rights, where you actually invest in the minerals and the products that are present underneath the surface. And this is also aggressive cash flow in the form of royalties, as opposed to interest or dividends or cash flow. It's actually investing in royalties, meaning that you're actually paid first before the oil and gas company, before the bank, before any other, loan product. You're actually getting paid before. It's something that I don't think a lot of people know about, but it's actually a very good way to hedge some of the risks that come with investing in oil and gas. Then there's precious metals, okay? And this is one of the best tried and true ways to invest in capital preservation. This is wealth preservation. Once you've accumulated it, you want to, be sure it's a safe haven, even in times of, economic turmoil. While it may not have a high cash flow, profile, it does have relatively good appreciation, but really it's wealth preservation properties. Then there's something called conservation easements. I put this up there because there's not many ways that W-2 income earners can shelter their taxes, but at the same time making an investment into real assets. What a conservation easement is essentially an area of land where the government is very interested in not having that area of land be converted into some sort of real estate producing asset, like a big community development or a office, park. They want to conserve that natural environment. And so they incentivize that by creating these really big tax breaks that you can actually invest into. So it can be both that philosophical, conserving the environment, and it can, if your priority is to shelter specifically your W-2 tax earnings, it can be a vehicle as well. So those were many different types of real assets that you can invest in, and they each have different profiles of why you may want to invest in them. Some strategic considerations that you can also consider in addition to that is how you invest. You can invest with different tax deferred vehicles, either your 401k, an IRA, or an HSA. While these provide appreciation because they accumulate tax-free within that vehicle, they don't necessarily provide any cash flow. So if you're more of a appreciation, wealth preservation investor, this may be an option. Then there's the demographic trends, like I mentioned, the momentum, the migration patterns, the baby boomers. We see a lot of people moving to the Sun Belt. We see a lot of retirees looking for 55 plus adult active. There's specifically an asset class for multifamily for just that group, 55 and up. And you can invest into that asset class. There's this newer asset class called build to rent on the multifamily side. They're making single family homes in community settings with amenities like you would get in a apartment building. But with the trend of, and because of the trend of folks wanting their own space, their own yard, their own safety without living in crammed regions, especially after COVID, this is becoming a popular asset class. And so the momentum is shifting there. It's becoming harder and harder to buy your own home, with the rising interest rates and the inflation effects on the price of valuations of homes. Many people see these build to rent type of investments and developments as the next wave of renters, as we become a renter nation. Then there's macroeconomic trends, and this is something you always have to keep an eye out for as an investor, is what are the economic trends? What are the central regulatory trends that are impacting people's decisions? What are the energy demands that's, shifting folks to pursue certain types of residences, certain types of regions in the country? These macroeconomic trends has to be included in your investment strategy and philosophy. So a few case studies of how I kind of incorporated those concepts into my investing with time capital. So Alamo Oaks is one of the very first deals I did as a limited partner. This is an investment I made in 2019 in San Antonio with a group that I got to know who's based out of Houston. 239 units. They recently sold. This is residential, multifamily acquisition. So I was investing for conservative cash flow, and that's me. I'm not a super aggressive. Every now and then I'll swing for the fences, but for the most part, I want to hit singles. I want conservative, lower risk type of investment. So I wanted conservative cash flow, but I also knew I was going to get capital appreciation as well. And so that, was a great investment. We saw they were able to produce a 7.3% average cash flow over the life of that investment. On top of that, they produced 12.5% in capital gains, which brought your average return over that 2.5 period to about 20%. On top of that, I was able to take the bonus depreciation from this passive investment and offset the passive income that I was getting from another investment in a medical office building where I was getting more aggressive cash flow. So you see how you can kind of start to combine these as you know the profiles of these real assets, and how they can kind of mutually, synergize and benefit off of each other. Next is a example of mineral rights. This is, a real asset. It's tied to oil and gas because it goes up and down with the price of oil. And remember, like I said, you get paid first. So that stack, a certain percentage of it automatically goes to the mineral rights owners. And this is what attracted me to it. I only learned about it last year, but I did a deep dive with the group that I invested with out of Dallas. So bought 2 acres of land in the Oklahoma region. This was a purchase last year. Since then, it's actually produced 15, almost 16% of cash flow over that time. And that's all in royalties, right? And their projection over the life of this year, which is actually, that's a typo, it's 25 to 30 years, the projected cash flow can be as high as 25 to 30%. And if you think about the momentum and the economic cycle and where we're at, the price of oil is more than likely to go higher than it is to go lower. And that's because if you're paying attention to the macro, you're seeing that there's a lot of ESG regulation that's limiting the amount of new oil production. Therefore, the existing private oil fields are now going to experience this upward pressure on their investment, on the value of not only their real estate, but the commodities that it produces. And so over the life of this is, projected to be a $94,000 return on the investment. And so this can be huge when you start putting everything together and determining your investment thesis. Also invested into farmland. And this is actually an international investment. So in 2021, made this investment, bought a lot of land in Paraguay, where they're growing multiple crops. And I invested in 320 citrus trees of agricultural farmland. And the investment is something that has a bell curve. As the crops are growing, the return, the cash flow that you can get from it goes up as you get deeper and deeper into the investment. So the actual peak of the returns comes at year 7 to 18. And then you can still continue to hold it for another 7 to 10 years. And so this is a super long-term investment that you can invest not only for, cash flow, but for legacy. Some of these you can reinvest and go another 25, 30, 40, 50 years. A lot of timberwood can be invested in this manner. And so again, different strategies for different types of investments, and it can match your goals. So this is a build to rent, and we talked about this. 131 units invested here in North Houston area. Purchased in 2021. It's a development deal, so we're not expecting cash flow from it, but it's something that I've grown to be attracted to because I see where the puck is going. We're becoming more of a renter nation, and so I want to get ahead of that and invest into these type of developments. And so we can see the projected returns here, and projected return of a 16% 3-year hold, which is typical for a development. Currently getting leased up 30% at the current moment and growing, but I feel confident that it's going to get leased up because more and more people have to rent. They're being, being influenced to rent based on all the factors of the macroeconomic picture. So that's just kind of a look at some of the ways you can invest in different real assets, different reasons why. And we can do this as both limited partners and general partners. And I'm now doing both. For the first 6 or so years, I was just a limited partner, learned a lot, developed a lot of social capital, right? Knowledge capital, experiential capital, and now parlaying that into general partnership where we're trying to leverage those relationships and help bring other people into that community. Specifically, my passion is to get other physicians and healthcare workers into these roles, whether it's a limited partner or as general partners. But this is how it all ties together. And it looks different. General partnership means active role in the business. It means you do have more control, but that comes because you're putting in more work. And therefore, you get rewarded more. There's a higher equity multiple, and you can have more aggressive scaling. Again, you can compare an aggressive versus a conservative play. You choosing to be a general partner is an investment, right? You're going to invest in things in yourself, and this can be a more aggressive scaling return on that investment. You get the social capital because you're putting yourself out there to investors and limited partners. You're actively growing your community. You can be a limited partner. And honestly, I thought I was going to be a limited partner forever. I love the idea of just leveraging the smartest people like XI Capital. I'm in one of their deals that's knocking it out the park. I love the idea of leveraging, other people's skills and talents, their intellectual capital, right? And gaining from that. So this can be a semi-passive role. And I don't want to say it's completely passive, because there is some work that goes into making a wise investment into these general partners. But after that, it can be passive, and you can definitely build wealth as an investor on the investor side of the equation, of the spectrum. You have less control, so it's a trade-off. But I think, to me, that's for a reason. It's because I'm trusting those who are great at what they do and love what they do. So yes, it's a lower equity multiple. It's a more steady growth to that financial independence and financial freedom. But with time and good investing, you can get there. There's no reason you can't. And there's great examples of that. Conservative scaling and passive income, as we mentioned. So, like I said, what does it mean to be a limited partner? There is some activity involved. It's not just signing over a check. That would be reckless and irresponsible investing. But your role is essentially to provide the capital. But you vet the general partnership. You take a look at the team. You do some due diligence on them. You ask questions. You check testimonials, and you really take the time. This is the most important thing you can do as a limited partner, and it is semi-active. You have to be involved in that process. You also need to vet the market and the deal itself. While those are important, the general partnership is number one, but you still want to do these things. And that goes back to the macroeconomics. You want to know the trends. You want to know specifics about the deal. You want to take what we just learned about the different asset classes and apply them to everything in the big picture. Like I said, understanding the market, I think this is the second most important thing that an LP limited partner can do. You want to understand location, migration patterns. You want to know where the jobs are going, where the population is going to follow those jobs, and therefore rent growth will follow that. Community growth will follow that. You want to understand big picture like geopolitics and monetary policy. Everyone's watching the Fed. If you're an investor, especially if you're an operator general partner, you're watching federal policy. You're seeing where those interest rates are going and how that can impact some of these real assets. You want to know about local regulations, and how those can impact your asset, your investment. Some states have very loose regulations where business friendly and landlord friendly. You want to know that, versus there's other states that have more tight grip on that business cycle and opportunity. You want to know things like crime rates, school ratings, things that matter to people. This is that cultural capital now. You have to have the awareness of this and why it matters to people to choose this type of market and make a smart investment into that market. Now, on the general partnership role, this is absolutely available for us. I think XI Group can attest to that. But what does it include? I had to learn this. I for the longest time, I didn't know, that these are so many different things that go into it, and I didn't have to do all those things. I actually thought there was no way I could be a general partner because I don't have all this intellectual wealth and capital and experiential wealth. But the great thing with syndications is you can bring together core teams, GP teams, can split up the roles, but it involves finding deals. It involves underwriting. Then you have to manage everything. You have to put all the pieces together. Sometimes you specifically have to manage construction if it's a development deal. Sometimes you have to manage rehab if it's an acquisition and you want to value add. You have to manage the property managers. You can even come in as a loan guarantor, especially if you're a high income earner with already a high net worth that you've built up. So you can still play on the general partner side, even though you've accumulated wealth as a limited partner. There's risk capital, there's investor relations and capital raising, which is my main focus, in addition to many of these other things. I want to give some examples of this, so make this real tangible and realistic. So one of my partners in many deals and in our biweekly webinar, we provide education. This is Dr. Adebayo Fasanya of Dr. Breathe Easy Capital. He's CEO and founder. He's actually a full-time W-2 ICU critical care pulmonary physician, but he's able to, leverage all his other forms of capital and get into these real assets on not only the limited partner side, but he quickly graduated to the general partner side, and he's done great. He has 141 million of assets under management across multiple different real assets, multifamily. He has oil wells. He has senior living development. He has self-storages all over the Sunbelt area. So a great example of success. One of my friends from my mentoring club is David Zook. He's founder of the Real Asset Investor. And this guy's just a rock star. He started probably less than 8 years ago and has been able to raise over 800 million of capital, growing community and teaching them the values of investing in these real assets, things like energy, self-storage, ATMs, again, material, right? This is actual physical thing that provides value to people, car washes, so private businesses, real assets that provide real value on a day-to-day basis. And he's been able to do really well in that endeavor by partnering with general partners and operators who have the expertise, and you combine that with the capital and you create this ecosystem and this community. So this is available to all of us, and we have to know that we can overcome some of the real and maybe perceived barriers to entry. Do you need a degree? I think a lot of people on the call are doctors, and you know how long that took to get that degree and to get the training. No, you don't. Actually, the knowledge is out there. There's communities out there to help you and facilitate your growth. You can go that route like I did with a full-on mentoring club, 150 people who I can tap into, varying, seasons of their investing career. Some are well-seasoned, some are newer with great ideas. You can tap into that. Or you can go direct with a mentor, with this apprenticeship model where you work with one person. And this is actually how my partner, Bayo Fasanya, did this. He worked with one mentor, and he was able to provide value to that mentor and also gain from their experiential capital. There's investor mentoring clubs. We're on one tonight. I host one on a monthly basis where we gather community. We create, a space to trade ideas and associate with each other. Lots of self-education out there. We're in an amazing time of humanity where, the technology has allowed us to just get this information right at our fingertips with internet, YouTube University, books, podcasts. You can listen to it on audiobooks while you're performing other tasks. It's never been more accessible, and that gets me really excited. And now you're getting this push from artificial intelligence, and who knows how big that ceiling is now. And so I always encourage everyone to always be curious and be social, even as you start. It's actually the most important as you start is to be curious, have that interest of learning what's out there, what you don't know. And then that social capital is invaluable. Just developing those networks, going to meetups, going to webinars like we're on tonight, even traveling. Don't be afraid to get out there and leave the city limits, go to another city. I've gone to other countries to go to investor meetings and conferences. You'll gain so much value. You'll find like-minded people. It'll broaden your investing philosophy, and you'll be on that journey to that financial independence and freedom. So there's also ways to, not just do this. You don't have to do it alone. You can do it in individual small groups. Yes. You can get into your own personal portfolio. You can joint venture, as I mentioned before. You can join large groups by syndications. You can invest into REITs, which are kind of a paper asset, but it still ties into real estate. There's even crowdfunding that lowers the barrier of entry because they usually have a lot lower minimum. Typical minimum for these, what we call private placements, average around 50 to 75,000. Can be as high as $1 million, I've seen, depends. But with the crowdfunding option, which is leveraging technology, it's able to get groups of communities together and invest at lower amounts. You can get in at $5,000. So there's really a lowering of this barrier to entry, and there's no reason we can't be on the investor side of the spectrum. So scaling, once you've made that commitment, you start making investments. Very important to just kind of define this progression. You want to invest. You want to keep in mind the concept of refinancing. The wealthiest, they almost never sell, they refinance, and that's strategic because when you refinance, meaning you pull the equity out of the appreciation, you get that monetary payoff, you get that return, but you actually never exit the deal. And this has huge tax ramifications because you don't pay taxes on that refinanced capital, but you can now get into a new deal. You can find a new real asset to reinvest in, and you just repeat this over and over. You're going to have some bumps on the way. You're going to learn from those bumps. So it's not to be afraid of, fearful of. It's something to learn from, and it actually makes you a better investment so that you can get back into the game. And if you do this right, you really can grow your wealth. You can grow your cash flow. And I like to kind of put numbers on it. I think about $3 million. If you maybe take 5, 10, 15 years to accumulate this amount of allocated capital into these real assets, on average, say they're returning 8%. That's $240,000 a year. That is the average physician salary in the United States. So over time, this is really tangible. This is really doable, right? And so I love to kind of put numbers to this. Next important thing is, for sure, you need to incorporate a comprehensive wealth plan. So it's not just about how much you make, it's about how much you keep. And you want to protect those assets. You want to create entities that are very well, bolstered against, litigation or loss of capital. You want estate planning because this is about generational wealth, and this ties directly into estate planning, which is a complex process. You need very well-trained professionals to be able to create those entities for you. And of course, we've been talking about tax strategy, keeping the highest cost in your lifetime down to a minimum. And this takes preparation. It's not just about talking to your CPAs in the beginning of the year, or around tax time. It's actually about talking to them the year before to prepare for the following year and take certain steps in order to create the best tax scenarios for yourself and your family. So in conclusion, real assets is a potent means of creating generational wealth. As we can see, there's many different options and many different ways to do this. And I think that's nothing but a good thing, right? So there's many ways that can fit your personal goals, your investor goals. And anyone can start today, as long as you stay curious and be social and grow your network. This is something attainable for everyone. And with that, I'll definitely like to open it up to questions. This has been great just chatting with you. It's one of the things that I'm really passionate about. It's really eye-opening, material and content that I've learned about, and I love to share it. And I hope this has provided value. And I'm happy to take any questions.
This is quite fantastic. Thank you so much, George, for that amazing summary. I do hope that for those that may be interested, in having a copy of your talk, that it's available either in the PDF format or whatever format it's possible. That's one.
Absolutely, not a problem.
Awesome. And then for the rest of the audience, if there are any questions, please do drop them in the chat. I see a question from Chikaz here already, and I'm going to bring that up very shortly, but please feel free to drop them in the chat, or you could just come on video, on mute, and ask a question, and just raise your hand on video, and we'll pull you in to ask your question. So the first question that came in was from Chikezi Okoro, who says, can you shed some light into how the medical office class has a higher operational burden? I'm curious how that compares with the operation of multifamily.
Yes, absolutely. The operational burdens come in many different flavors. The cost of equipment, very, very expensive. So right away, your cost of doing business is so much more higher. That game that you have to play to balance out income and expenses is a lot higher. The type of personnel you're hiring, meaning the staff, these are very qualified, well-trained staff. You can hire a whole anesthesia department, CRNAs, Leslie's a CRNA. So these are highly trained, staff. You can hire scrub techs, nurses, and all of those are vital to keep the functioning of a medical facility going, like a surgery center or a hospital. Operational challenge, these very thin margins. Hospitals, they make a lot of money, but they also, operate on very thin margins due to escalating costs in healthcare. And it can be due to various things, medications, the inflation effect on equipment. So operationally, it's much more of a challenge versus multifamily. Still a challenge, don't get me wrong, but you're dealing with other types of stakeholders, the property management team. You're dealing with marketers, you're dealing with the tenants, right? And those, I call them, they're partners in the investment. You're providing home for them, they're providing capital for you. And so, it is, has its own challenges, but I think the barrier to entry is a little bit lower compared to the complexities of the medical healthcare industry.
It's beautiful. David Buckman says your passion shines through. I second that. Absolutely.
Thank you.
Will mentorships exist for beginners? Rafael Hernandez says he's currently in New York and he wants to know what mentorships exist for beginners.
Yes, I always like recommending a couple of sources that I think are amenable to a beginner digesting the language of investing in real estate. So I started on Bigger Pockets. The way they deliver information is very absorbable. I also like the tribe, the community that I joined, the real estate guys. Again, they give it to you in a way that you can digest, and they give you the macro approach. And then I like Excite as well. They have great opportunities. Their underwriting classes, people know about this class. And underwriting is one of the more complex things if you don't know Excel, if you don't know those type of, aspects of investing, it can be very intimidating. So I think those three are great sources.
Yeah, thank you so much, George. And very soon we also will be releasing some information about a mentorship program that we're starting. Which will be some of it will be group mentoring, but there'll be some opportunities for some one-on-one mentoring. So we really appreciate the plug for sure, but we certainly it's always super excited to provide value to the community. David Buckman, Incam, Dr. Incam, as your mama says, George, your wealth of knowledge is truly incredible.
And Cam, you're
Thanks for
amazing.
Awesome. And David was also asking, as a designer of over 30 medical buildings and much multifamily mixed use work, he agrees that multifamily is very much easier. Thanks for that comment, David. Abigail was asking about how to get more information about the oil and gas and minerals investing.
So I can answer that kind of specifically, and then in general for any of these real asset classes. You'll be surprised how many events are available, whether it's a webinar or a in-person meetup or a conference. So start with, the easiest thing, get on the internet, get on Google, get on Facebook. There's Facebook groups where you can just Google oil and gas or mineral rights investing, and you can even see what's in your area, what's in your neck of the woods. And if not, then yes, you may have to travel a little further to get that into those spaces. But you'll be surprised. There's a lot. LinkedIn, great a place to kind of make a detailed search for these operators, these businesses, these companies that invest in these things. And I'm happy to share the few that I'm aware of, just from my experience over the last few years. Not an endorsement, just my sharing of resources.
Fantastic. Abigail is pretty excited about that and says, please share. Tanisha was also saying, thanks, George, for that great info. Thank you so much, Tanisha. Really appreciate you.
Dr. I'm unable to raise my hand on here, but can I ask a question to Dr. George?
Absolutely, right now.
Hey, Dr. George, first and foremost, thank you so much for giving up some time tonight and providing a lot of value to the community. Earlier in your presentation, I saw that you invested over $1 million as an LP. What were some of your biggest learning lessons? And a two-part question, what did you gain from that when you switched to the general partner side?
Absolutely. So my first investment was in 2016. So I did enter into the economic cycle, the macro here. I entered into the economic cycle when it was going up. And so luckily there's been a lot of success. Over the last 1 to 2 years, that has changed. And so, I'm starting to get some of the friction and the headwind, and I'm starting to learn lessons from my more recent investments that I'm now happy to go back and take a deep dive, reflect on what I was thinking when I chose to invest in that time in those deals. And so those deals were a lot of bridge debt, meaning variable rate debt that's now being impacted by interest rate policy, monetary policy. Again, macro, you got to understand, right? And so now I'm looking at what could I have done differently? How could I have, mitigated some of that risk of those investments? So there has been some hurdles, right? And I'm happy to learn from those hurdles. There was another part to your question.
It just what did you learn from as an LP to bring over to the GP side of things?
Absolutely. So being in an LP, and I didn't mention this, one of the great advantages is that you are getting an education just by being an LP. This is one of the best ways to get into some of these asset classes. If you ever want to be a GP in multifamily, invest in these multifamily deals as an LP, because you're going to get the presentation, the webinar. You're going to get monthly updates. You're may get a quarterly and annual update where you look across the entire portfolio of that company. You're going to get to ask questions. You're going to get to meet in person on webinars and ask questions. This is an education process, and you're essentially potentially getting paid for that in the form of cash flow. So, we're used to taking on debt for our education, you're actually getting potential return, and getting that education. And so you can leverage that. And so that's the educational piece. And then there's the social piece. The 3 deals that I've done at GP and have all been with operators who I was an LP with, because I got to know them and I got to establish a relationship with them. So now we know who we are. The synergies align. I know kind of how they communicate, how they think, their philosophy, their investment strategy. And so I feel comfortable joining them, combining forces and helping them in their deals. So very, very influential, lots of returns from being an LP, not just the ROI, cash flow.
That's an amazing answer to that question. I love it. And certainly couldn't have answered it any better. Thaddeus, I know I'm probably messing up your name, Thaddeus Miller, but she asks, can anyone refer sources for capital? Some of us are not doctors. So, George, I'll let you take the first stab at that one.
I want to first clarify what you want to refer, or you want to refer.
No. I guess the person is asking for what are the other sources of capital? How can they get access to capital since they're not a doctor? It's a she. She said.
So I'm assuming financial capital, because we got our 9 forms that we know.
Time capital. They got time.
We got so if you don't have financial capital, you have to leverage the other forms of capital. Okay. And so it's not a barrier, and it's very common. How many of us have heard that? I just don't have the money. Like, it sounds great, I just don't have the money. When this is where you got to leverage that social capital. And that's why I mentioned that social capital could even be more important than the financial capital. Start learning about these investments, start going to meetings, start developing intellectual capital, social capital. Maybe now you can help a mentor and start getting on their radar and, maybe you can work for them, develop a little income, start creating a little additional income stream for you to invest in. The real estate guys, one of the first investments that the leadership invested in was a JV, where the first person, the one who actually put the deal together, actually didn't bring any capital into the deal, but because of his social capital, he was able to bring high income earning investors, 4 other partners, into the deal to bring the capital. He gave everyone a great return, but at the same time, he got himself into a performing asset, and got into the game. And now 30, 40 years later, they have a great investing career without investing any capital of their own. And so if you, YouTube University, invest with no money down or no capital, you'll see a lot of examples of way to leverage the other forms of capital to get the financial capital. But I love that. That's a great question, because we hear it a lot.
I love it. I love it. And I mean, just to also bring it to life, I mean, I know of people who didn't have any capital, but just learned the details of, finding deals and deal flow and underwriting deals, and actually started to find these deals themselves, and then bring the deals to operators like us. I know someone recently who was like, in the medical field, did not have any capital to invest, but was able to find a deal that it was able to take to some investors. Guess what? It got its share alone of the acquisition fees, $50,000, and then it still got a portion of the deal moving forward. So, and that's
Beautiful.
who put zero capital into that deal, and was able to still be part of the general partnership group of the deal by just taking a big portion of the acquisition part of the splits. So there's many ways to do it, but you're going to have to invest some time, energy,
Time capital, health capital,
some time capital, some health capital, some social capital. I forgot the other capitals, but you're gonna have to invest a lot of other capitals to get the financial capital. Excellent. How much would you say, Wale Goodwill is saying, how much would you say is good to start off with investing as a fresher?
Like an initial, like a capital amount. So I like this question too. With my strategy as an LP, when I started, I purposely invested the minimum amount. So try to find the minimums. And this is actually typically what most investors, even experienced investors, still usually invest the minimum. But invest the minimum amount, couple of reasons. You don't want to put too much at risk, not only for your own, stability, financial stability, but you don't know who you're investing with as a starter. You need to kind of test these operators out. And so I wanted to test as many operators out as possible. So with my pot of capital, disposable capital, I needed to give the minimum in order to test as many out as I could. And so I didn't want to overcommit, put too many eggs in one basket. So I would say, look at what the minimums are. Usually start with the minimum. The very first investment, obviously, is the investment in yourself. Invest that time to sit down and educate. Invest a little capital, $100 to go to a webinar, or excuse me, a weekend course. $200 maybe a month, or $100 a month, $74.99 a month to invest in an investor mentoring club or a mastermind. So invest in yourself first, and then once you actually get to the deals, try to stick with those minimums to kind of get that initial exposure. Over time, you can pare it down, which is now where the phase I'm in. I'm trying to pare down to the investors who I've enjoyed working with, who've done great job, and who are just doing good things. So that's kind of the strategy on that end.
That's beautiful. I love that answer. And I have a question for you. For those investments where you've had some challenges, and you've kind of like add some losses, or maybe particularly those ones where you talked about the capital being bridge debt, and I mean, what was the outcome of some of those the losses? Were they?
Right.
Did you end up with having to respond to a capital call, or I mean, like, what's the? I guess I wanted to create a picture of what the worst could be.
Yep, and it's a spectrum, and I think they're
George,
all
just to piggyback off that question, will you give us like a percentage of like the ones that are doing well and the ones, as much as you can share, just to piggyback, just so people can know where we are, what some investments have done really well, which ones aren't.
Sure.
Since you've invested in so much.
Yep, and I can kind of give the timeline of this transition, right, from the the upcycle to peak, and then now it's starting to kind of correct. So back when I first invested, let's take cash on cash return for a multifamily value add acquisition. When I first started investing, you can expect 8 to 10%. And that was the pro forma projected. And a lot of times they were over delivering. They were getting double digit cash on cash return. As the cycle progressed, you started coming down. I started seeing deal flow that said 7 to 9%. Then it was 6 to 8%. Now it's down to 5%. I've seen some that, 5% and below, which starts to match like the returns you can get apples to apples on a money market fund or a high yield savings account, right? And so that's something that I've seen not only in projections, but also in actual deal flow, or excuse me, actual deals that I'm in, where now the deals over the last 2 years that I've invested in, if they're delivering cash flow, if they're still making distributions, it's definitely in this 4%, 5%, 6%, some few are still getting 7%, and you got to look at that. That's what I'm looking at now. I'm like, who's actually still performing at a fairly, good rate, and who's being more affected by these interest rate hikes. That's the beginning of the spectrum, right? Start lowering cash flows, promised cash flows and actual cash flows. The next thing is to start holding distribution because you're worried about your capital reserves not being able to, meet these increased expenses, not just interest rates, but property insurance, taxes, materials for rehab. So that's the next on the spectrum, is these pause distributions or decreased distributions. Then there's the capital call, the dreaded capital call, right? Where they foresee, or they are already in a situation where they have to go and get more. They don't have enough capital to cover their expenses. And so now they have to go back to the investors, or beyond that, next spectrum, they got to get outside third-party money. This is going to dilute. You're already going to dilute shares by bringing in original capital, original investor, additional capital. That's already dilution. And I'm in 2 capital calls. About 50% of the deals are in pause distributions. 2 are in capital calls. And so I know I'm going to get diluted, whether I invest in those capital calls or not. I know it's going to get diluted. So this is going to have an impact on my return. So instead of maybe that 20% average annual return, it's going to go down in half, 10%. And that, remains to be determined, but some of them are projecting, yes, you can lose half, 50% of what we originally projected. And so I'm looking at that. I'm watching that. What else was that? What was your question, Julius?
Oh yeah, I mean, you broke it down.
Was it okay? I wasn't sure.
Because on the platform, a lot of times we talk about the upsides. We talk about the profits, and we could show evidence of of deals that we've done where you show that evidence of the deal where you got 20% average.
Right. I showed all the good things,
and that was beautiful.
Right.
And we Excite Capital talk all the time about deals. The deal we went full cycle on, where we gave investors 30% average annual returns. But I think it's also just as important to talk about the other side of things.
Absolutely. And I just remembered the other last bit of your question. How bad can it get? You can lose all your capital. And so I have some friends that have lost everything. And it is just the saddest thing. We've heard some headlines here in Houston about deals and syndicators who have literally lost the entire capital stack, of equity, for the LPs. They brought in investors, or they had to sell back to the bank, sell to, aggressive, private debt funds. And so luckily I haven't gotten that bad. The worst I've gotten is these 2 capital calls. I know I'm going to get diluted. It remains to be determined how bad that dilution looks like, but I'm going to take that as a learning lesson. I'm going to learn as much as I can from them. The good thing about all the pause distributions is that the business plans are still sound. So they're still increasing rents. They're still, getting the preferred return, and they're just holding it. It's instead of in my bank account, it's in their bank account. And so they plan to restart distributions once it becomes more financially clear and economically clear. So that's the situation. Yeah, it's a big spectrum, and it can get severe.
This is fantastic. I mean, I love the fact that you went into that much detail about it. I think it's super important that as an investor, without risk, there's no reward. And we have to realize that no one is going to bat 100%. You know, even the great Dr. George Ozoude is not batting 100%. But the beautiful thing about it is if you do it enough times, if you do enough of them, you will eventually take some licks. But the goal is to have way more wins than losses, and that your wins can continue to compound over time. That's the game. Yep. At Excite Capital so far, obviously we grew up in that in that economic under those macroeconomic conditions you just explained or described right now. And we've been really lucky because we were super conservative.
Right.
We were still able to continue giving distributions, and we've not had to do any capital calls for any of our deals. And we're weathering the storm real nicely.
This is huge.
But we do really completely understand exactly what you're saying, and we are going through it right now. It seems like we are finally getting to a place where we're almost like at the nadir of the challenges, and we're about to start hopefully starting to go back up the ladder again. But I think Dr. Nkem wanted to make some comments, and then there are some other comments that we may be able to add on. But Dr. Nkem, please go for it.
Just real quickly, I wanted to kind of ask one more question. What would cause you to invest more capital into those capital calls? I'm assuming that you are sitting out right now, but what would make you put some more cash into it?
It's a good question. You have to decide if it's good money chasing bad deals. Is the business plan still sound, right? Are you increasing the rents? Is your occupancy staying high, or is it staying at the right amount? Because you don't want it to be too high, right? Is just the expenses coming from your debt service, and then what is the time frame? What's your runway? If you make this capital call to get more money, how much money are you raising, and how much runway do you have? Are you raising enough to last you 3, 4, 5 years? And then what are your thoughts like on when this cycle will really officially turn? When will the Federal Reserve stop raising rates? When will we actually start dropping rates? That's a speculation. No one has a crystal ball, but you want to know that you have a long runway if you're raising this additional capital and the deal is still sound. I would look at those factors.
Fantastic. That's just awesome. I think we have only about 3 more minutes. There are some great comments in the chat, so please check them out from David and Ezra Rod Sanders. For those that are new to the Excite Capital platform, if you want to continue to get invitations to forums like this and get to review some of our deals as they come on board, please feel free to Kayla or Miles, please put into the chat the information for people to text to, so that they could be part of the community. George, I cannot say thank you enough to you for this amazing presentation. and for your insightful responses to the questions that's been asked. Typically, for the last 30 minutes of the meetup, we actually do a little bit of introductions and get people to kind of chime in and do some social some networking. But the topic you presented on and the depth of your knowledge and enthusiasm really carried us through, and we really don't have any time to do that anymore. Everybody was asking questions, but adding comments. The engagement was great. And yeah, so I guess everybody's just gonna have to go have those cocktails right after this. But thank you so much to everyone that's joined us. We just want to say thank you on behalf of Excite Capital. I want to say a big thank you to you all. You could be anywhere else in the world today, but you're here with us. We don't take it for granted. We really, really appreciate you. We wouldn't be who we are today without every single one of you. So we look forward to seeing you next month. First Monday of every month will be the next meetup, and we'll be introducing the meetup speaker in the next couple of days to weeks. Thank you so much, everyone. I think please in the chat, please let's all say thank you to Dr. George Ozoude.
And I got to take a moment to thank you guys for the opportunity. Thank you, Julius. Thank you, Leslie and Tenny, the whole crew. You guys are an amazing community, and it's been a great time just getting to know everyone and growing with you guys. So thank you again.
Thank you. We're going to be doing some deals together soon.
Sir, let's do it.
Yeah, absolutely. Absolutely. Thank you. And everybody's saying thank you in the chat. Please don't forget to check out the chat, George, and feel the love being poured out to you over there. Everybody,
see it.
Have a beautiful night. Thank you.
Thank you, everybody.
Everyone be well.
Good night, everybody. Thank you,
We'll get
Dr.
the
George.
slides and the recording to you. Don't worry. No worries. Yep. Awesome. Thank you, everyone.